Welcome back to Smart Stock Sam. Today we are breaking down one of the most compelling asymmetric setups. We are talking about DataVault AI, ticker symbol DVLT, a Web 3.0 data monetization company sitting at 68 cents, while institutions are piling in by the millions of shares. Is this thing about to rebound in a major way? We have got massive institutional accumulation, serious business deals across sports, healthcare, and media, a revenue target that would make your head spin, and one very specific regulatory clock that is quietly ticking in the background. We are going to cover all of it right now, so stay locked in from start to finish, because the setup here is unlike anything I have walked you through before. Let me start with the number that stopped me cold when I first pulled this data. Between the fourth quarter of 2025 and February of 2026, institutional conviction in DataVault AI did not just grow, it exploded. And I do not use that word lightly. Vanguard, one of the most conservative, data-driven asset managers on Earth, increased their holdings from under 400,000 shares to 11.8 million shares. That is a gain of approximately 2,900%. State Street went from roughly 335,000 shares to 10 million shares. And BlackRock grew their position by 3,000%, now holding 4.1 million shares. Now ask yourself this: what would have to be true about a 68-cent stock for three of the most powerful institutions in global finance to simultaneously, aggressively, and relentlessly accumulate it at these levels? These are not momentum traders chasing a pump. These are the firms that manage trillions of dollars and have entire research departments dedicated to not being wrong. When they move like this, in unison, with this kind of velocity, the only rational question left for retail investors is whether we are early enough to benefit from what they clearly already know. And what they know comes down to valuation. Right now, DVLT is trading at 68 cents. The projected fair value from institutional analysis sits at $4.20. That is a potential 6 times return just to reach what analysts consider fair pricing for this business model. Not a moonshot target, not a best-case scenario, just fair value. Think about what that means for a moment. You are not being asked to believe in a miracle. You are simply being asked to believe that the market will eventually catch up to where the smartest money in the world already is. That gap between 68 cents and $4.20 is what traders call asymmetry, limited downside due to a low entry price with multi-bagger upside built on fundamental expansion. This is the kind of setup that professionals hunt for, and right now it is sitting in plain sight. But what actually makes DataVault worth $4.20? That requires understanding their business model, and it is genuinely one of the more innovative frameworks I have seen in the data infrastructure space. DataVault operates on what they call a data as an asset class model. Rather than simply storing or analyzing data for clients, they are building the infrastructure that allows entire industries to own, tokenize, and monetize their own data. They are scaling this model across 3 massive verticals: premium sports, media infrastructure, and healthcare Web 3. If you have ever followed companies like Palantir or Snowflake, you understand how valuable data infrastructure becomes once it reaches critical adoption. DataVault is applying that same fundamental logic to the blockchain-enabled economy, and they are doing it in sectors where the data itself is extraordinarily valuable. Start with sports, because the partnerships here are impossible to ignore. DataVault has secured agreements with Sports Illustrated, the NFL Alumni Association, and the World Boxing Council. These are not exploratory conversations or letters of intent. These are real agreements with some of the most recognized brands in all of American sports. They are using their platform to create digital collectibles and data monetization strategies for these organizations. And here is the part that caught my attention most. They are being mentioned in the same conversations as Palantir. When a sub-dollar microcap is being compared to one of the most well-respected data companies in the world, you either dismiss it as hype or you investigate further. The institutional accumulation we just discussed suggests the big players chose to investigate and then quietly load up before the rest of the market connected the dots. Now, beyond sports, DataVault recently completed the acquisition of API Media, which dramatically expands their distribution capabilities. But the real hidden gem inside their platform is something called the Information Data Exchange, or IDE. This is the infrastructure that facilitates digital twins and secure NIL licensing, name, image, and likeness. In the post-NIL era of college and professional sports, the ability to securely create, manage, and license a digital identity of an athlete is not a niche opportunity. It is a multi-billion-dollar frontier that is still largely unstructured. DataVault is positioning itself as the exchange where those deals actually happen at scale. Think about the sheer volume of athletes across Division I college sports alone, each with a brand, a likeness, and a growing audience. Could this become the dominant NIL infrastructure layer across collegiate and professional athletics? Could the IDE eventually become the standard clearinghouse for digital athlete identity, the same way EDGAR became the standard for public company filings? The institutions seem to think the odds are worth tens of millions of shares, and that kind of directional bet from this caliber of investor is not something you see every quarter. Then there is healthcare, which is arguably the most compelling and most misunderstood long-term vertical in the entire business. Through their partnership with Wellgistics Health, DataVault is launching healthcare as a service. They are using blockchain-enabled smart contracts to handle sensitive medical data securely and compliantly. They have also partnered with T-Burn Chain for tokenized data assets and Web3 scaling. Now, here is the thing about healthcare data that most retail investors underestimate. It is not just valuable, it is the most regulated and therefore most defensible data type that exists. Any company that can build the right infrastructure around healthcare data compliance creates a moat that competitors cannot easily replicate. The regulatory complexity that scares most companies away from this space is actually the thing that protects DataVault once they are inside it. And DataVault is doing something else entirely unique that I have almost never seen from a company at this stage. They are pioneering a digital dividend system for their shareholders. On February 27th, they finalized distribution for the Dream Bowl meme coin II, but the one coming up fast is the Josh Gibson coin, a one-for-one digital dividend for shareholders with a record date of March 9th, 2026 and a distribution date of April 30th. This is not just a marketing gimmick. It is a live demonstration of their own tokenization technology, rewarding long-term holders while simultaneously proving to the market that their platform actually works in practice. Could this digital dividend model become a new standard that other data companies eventually follow? It is not a question I would have asked 2 years ago, but here we are. Now let's talk about the numbers, because growth without financial reality is just storytelling. DataVault is growing at 181% on the top line. That is not a rounding error. That is a company in full acceleration mode. Yes, they reported a net loss of $94.24 million. And yes, that number is real and you should not ignore it. But context matters enormously here. They are aggressively investing in infrastructure, platform development, and market expansion. This is the Amazon model. Sacrifice near-term profitability to dominate the category before competitors can catch up. The institutions we have been discussing are clearly comfortable with this loss profile because they are focused on the trajectory, not the current snapshot. And that trajectory is pointed at a very bold number. For 2025, the revenue target is roughly $38 to $40 million. But for 2026, management is targeting $200 million. That is a 5 times jump in revenue in a single year. Is that realistic? Here is what makes it credible. As of February, the CEO highlighted $49 million in active agreements already secured. If the sports and healthcare contracts continue to execute as expected, that $200 million figure starts looking less like an optimistic projection and more like a conservative floor. To fund that execution, DataVault secured a $150 million strategic investment from Silex Holding Company. This is critical, arguably the single most important de-risking event in the company's recent history, because one of the biggest risks in sub-dollar stocks is running out of cash before the business model can prove itself. That $150 million removes the immediate bankruptcy risk that usually shadows companies at this price point. It gives them the runway to reach what could be a transformational 2026 without being forced into a desperate capital raise at the worst possible moment. So why is the stock still at 68 cents? Here is the catch, and you need to understand this clearly before making any decisions. DataVault is currently under a NASDAQ minimum bid notice because their share price is below the $1 minimum requirement. They have until August 24, 2026 to get the price back above $1 for 10 consecutive trading days. If they fail to do that, they risk a reverse stock split, which often creates temporary selling pressure and dilution. There is also an active S3 shelf registration for 5 million shares that could add some near-term overhead. This is the speculative component of the play. You are effectively betting that the fundamental growth engine, the institutional accumulation, the revenue acceleration, the partnership expansion, will naturally pull the stock above that $1 compliance threshold before the deadline arrives. The bull case is strong, but you need to know the clock is running. Now, before I give you my final take, I want to be very clear about something important. Nothing in this video is financial advice. I am not a licensed financial advisor, broker, or investment professional. Everything discussed here is for informational and entertainment purposes only. DataVault AI is a speculative micro-cap stock with significant risk, including the NASDAQ compliance issue, ongoing net losses, execution risk on ambitious revenue targets, and general market volatility. You could lose money. Always do your own due diligence. Speak with a qualified financial advisor if needed, and never invest more than you can afford to lose. Past institutional accumulation does not guarantee future price performance. This is not a recommendation to buy, sell, or hold any security. With that said, here is where I land on all of this. DataVault AI is a high-conviction, high-risk, asymmetric play. The fundamental pieces are aligning in a way that rarely happens at the 68-cent level. 3,000% institutional accumulation from Vanguard, State Street, and BlackRock does not happen by accident. A 181% revenue growth rate with 49 million in active agreements and a pathway to 200 million in 2026 does not happen in a vacuum. The data as an asset model across sports, media, and healthcare, backed by 150 million in fresh capital, is exactly the kind of infrastructure story that institutions reward with serious long-term positioning. The NASDAQ compliance deadline is real, but the fundamental strength here appears to dramatically outweigh the regulatory noise. If DVLT reaches fair value at $4.20, the investors who recognized this setup early will not just be beating the market, they will have executed one of the cleanest asymmetric trades of 2026. Now I want to hear from you. Here is my question for the comments section below. Do you think the NASDAQ compliance deadline is actually the biggest risk to this play, or is the 5 times revenue jump to 200 million the harder target to believe? Which of those two hurdles keeps you up at night more? Drop your honest take down there. I read every single one, and I genuinely enjoy the back and forth with this community. If this breakdown gave you value and opened your eyes to a setup you were not watching, hit that like button because it genuinely helps this channel reach more people who are hunting for asymmetric opportunities before they go mainstream. And if you are not subscribed to Smart Stock Sam yet, now is the time, because this is exactly the kind of deep dive institutional analysis I bring you every single day on names that matter before the crowd catches on. I will see you in the next one.